Hello everyone, my name is Kronos, and for today we will be going over depth of market, or in short, the DOM. So most traders basically rely on charts, some lagging indicators, patterns, but all of these are derived from past data. So the DOM shows you something completely different. It shows you the actual interactions between buyers and sellers in real time. So where liquidity is sitting, who is being aggressive, and whether price should move or not. If you understand this, you stop guessing and start reading the market as it unfolds. So before we dive in, here's what you'll learn and why it matters. So in this video, I'll show you how to actually use the DOM in trading, not just what it is. So we'll cover how to read it properly and the key difference between passive liquidity and aggressive execution, so the real drivers of price. You'll learn how to spot true buying and selling pressure, understand market strength versus weakness, and recognize important concepts like absorption, exhaustion, and iceberg orders. So the goal is simple: combine these insights to make smarter trading decisions. So the DOM is essentially a live view of the order book. It shows you where traders are placing orders and how those orders are being executed in real time. Here you have the DOM. On the left side, you have the bids, so buy limits, passive demand below price, of course. Then we have the ask side, which are the selling limits, passive supply above price. We have the market buys, so buyers lifting offers. We have the market sells, which are again sellers hitting the bid side. And we have the delta, which is the net difference between buying and selling pressure. So let's take a live look at the DOM. So as you can see, on the bid side, you have just buyers waiting. On the ask side, you have sellers waiting. So, but what really matters is not those orders, it's the aggressive traders. The market buys and market sells are what actually move price. So when I read the DOM, I'm not focusing on the size alone. I'm focusing on what happens when that size gets hit. So does the price move? Does it stall? So that reaction is where the information is. So here we are, passive versus aggressive market participants. So the core principle is price moves only when aggressive traders remove all available liquidity at a level. So here we have, in short, passive traders limit orders, provide liquidity to the market, sit on the bid or ask side, wait to be filled, but they do not move the price. Aggressive traders, so those are market orders, execute immediately, consume available liquidity, and are responsible for price movement. So this is one of the most important concepts to understand. So passive traders are placing orders and waiting. They're not moving the market. Aggressive traders are the ones stepping in and taking liquidity. That's what creates movement. But here's the key. So just because somebody is aggressive doesn't mean they're winning. So if aggressive buyers come in and price still doesn't move up, that means they're strong selling on the other side. The real question is not who is active, but who is actually in control. So here's one simple but important topic, so real market strength. So here's one example of strong buying pressure. You have continuous market buys, of course, large positive delta, and price is moving higher. Yeah, that's what you want when you see large buys and large positive delta, especially on futures. Open interest increase with that. But weak, ineffective buying is, again, high buying volume, large market buys, large positive delta, open interest increase, but price is not moving. So that indicates selling absorption. So here is an example we can try to go through, because again, DOM is a live analysis and you cannot have past data. For that you can use heat maps, of course, but again, let's try to go over. I'll try to explain. So this is where most traders get misled. So they see strong selling volume and assume the market is bearish. So, but volume alone means nothing. What matters is whether price actually moves. So for an example, if sellers are aggressive and price goes down, that's real weakness. But if sellers are aggressive and price doesn't move lower, it means someone is absorbing those sells. So here, for example, you can see a large amount of negative delta. You can see the price really did not move. How you can see this is via DOM live. So you can aggregate all of the exchanges here, settings, you can aggregate spot, you can aggregate futures or inverse. And for this example, you would see on the bid side lots of limits trying to protect these lows. And with that, you would also see here negative delta. And with that combined, you can see negative delta, you can see bid side limits absorbing all of the sellers. This is where you can have that absorption, and you can kind of anticipate a move to the upside. So you had nice selling volume, but the price did not move. So this is your main point you need to always be aware of. So that's where often shorts get trapped. So always focus on the relationship between aggression and outcome. So again, the main thing is markets often reverse when aggression fails to produce momentum. So price is not moving, somebody is absorbing it. So absorption is one of the most powerful signals in the DOM. You'll see strong buying or selling, but price refuses to move. So one example is, let's say, for example, we have a nice big ask limit. You can see that on the DOM. If you see the same amount of positive delta, so somebody has to buy, market buy into that ask limit. At the same time, if you have 150 Bitcoin limit at one price level, and then at the same price level, you have also delta or buys 150 Bitcoin plus. That means that limit on the ask side was not a spoof, it's a real limit. So somebody is absorbing that price, filling up the other side position, so filling up on shorts or selling Bitcoin on spot. That means the price is getting absorbed. So that means someone larger is taking the other side. So exhaustion is slightly different. It happens after a move. You see strong momentum at first, but then it slows down and stalls. That tells you the move is running out of energy. In both cases, the key idea is the same. So the market is no longer responding to aggression. That means, as I mentioned a couple of times, once price starts hissing, so this is for the example when the price wants to push up higher. Price is going higher, you see absorption. A lot of market participants are buying, again, with market orders. Large amount of limits are visible on the ask side, and they're just absorbing. You see the delta just being massively positive. The price is not moving, somebody is absorbing, somebody wants to reverse the price, they don't want the price to go higher, and that's where exhaustion starts to build. No longer buyers are participating, and the sellers have actually done their job. They have absorbed the needed amount, and they can then reverse the price, especially if they have distributed via spot a lot of orders, or they have accumulated enough of short positions with, again, ask limits in our case, that they now feel certain that they can reverse the price and then get those profits. Okay, so here is one topic that I know a lot of people are scared of. Maybe they think it's too complicated, but in fact, it's really simple. So how to identify it is repeated executions at the same level. So continuous volume prints, visible size does not disappear. What it means, a large participant is active, the level is being defended. What this means, this iceberg limit can be really strong support or resistance, so potential reversal or reaction zone. So the iceberg orders reveal the activity of the large players. On the DOM, you may only see a small visible limit order. For example, you have here 100 Bitcoin on the ask side or 100 Bitcoin on the bid side. But behind it, there can be a much bigger hidden position, often managed by algos or bots to avoid showing the real size. So when price touches that level and aggressive buyers or sellers keep hitting it, the visible order may stay nearly the same. So if you have that 100 Bitcoin, it may stay the same while the delta or the buys sells increase really sharply. So as I mentioned for that example, so let's say we have a 100 Bitcoin limit that's visible on the order book, so also on the DOM, but 200, let's say 400 plus volume trades into that. So let's say we have here 100 worth of limits on the ask side, but on the delta you see like 200, 400 worth of Bitcoin positive delta, and you see buys also 400, 500, stepping it in at that price level where we had those 100 Bitcoin limits. So that's a strong sign of an iceberg, and with that, so it shows hidden size is being filled in the background, and these levels often act as strong support or resistance with quick market reaction. So keep an eye on those. So this is how you can kind of spot iceberg orders. So yeah, guys, individually these concepts are useful, but the real edge comes from combining them. So you identify a level first, then you use the DOM to understand what's happening at that level. So that's how you move from guessing to reading the market. But that's it for the educational video, guys. I hope this gave you a clear understanding of how to read the DOM and apply it into your trading. Thanks for watching and see you in the next one. Bye bye.